Welcome to TheoTrade. This is Don Kaufman. Here we are. It's April 18th, 2017. First and foremost, no, we're not going to jump to the S&Ps. We're not even going to look necessarily at the Nasdaq. Okay? Forget about earnings for a moment. Pivotal move inside of the bond product that has this breakout all the way into the 155 handle. Now, I've zoomed out to a bit of a broader chart because I really believe that this is possibly the most important thing on your screens in today's marketplace. I know people are very, very myopic. They're always looking at the S&Ps, they're always looking at the Nasdaq over here. But you have to ask this question. And again, why am I focused a tremendous amount on bonds, which is ultimately the debt market? Well, first and foremost, the sheer size, the magnitude, okay, of the debt markets, it's monstrous in comparison to the S&P 500, okay? In addition to that, obviously, as the bonds themselves rally, okay, the interest rates, the yields associated with these go down. And that has a negative implication, again, a large negative implication to the financials and, of course, the broader S&P 500. But the reason I bring up bonds, and it's such, again, a pivotal move over here. I'm not much about support and resistance, but the bonds do have this kind of breakout to the 155 level. And the only time frame you have to compare this to is, again, just into the time of the election. So the bonds are cruising about the 160 range. The election happens, the bottom drops out of them, the interest rates go flying up. Now we're seeing quite the opposite. The question that you need to ask yourself, it doesn't matter at this point, okay, whether you're a trader, whether you're an investor, okay, hey, whether you're looking to bonds and trying to just capture some yield because you don't want as much risk as the S&P 500 has, doesn't matter. You have to question, what do the bonds see that the rest of us don't? Why, okay, is the world right now moving back into fixed income when we were all told, oh, that's it, it's over, fixed income is hey, listen, the yields are going to go up and the bonds, this is going to be bond Armageddon, the bonds are going to sell off over here. Yeah, well, ever since the Fed really started tightening interest rates, we've seen nothing but the bonds rally. And it's something you really need to think about. And the reason I'm getting to this is the bonds rallying, okay, in more recent times, and this correlation has not always held true, but in more recent times, the bonds rallying have almost been like a display of risk, like the VIX. So we look at the VIX, okay, and we see the VIX clearly has been rallying. Okay, obviously yesterday, today, maybe backs off just a little bit, but the VIX has been on the move once again to the upside over here. But the bonds, which is tremendous amounts of capital, okay, on the move over here, they're not just moving, on a percentage basis, are exploding to the upside. Again, a 10-point move inside of the bond product is an unprecedented type move out there. And is this, again, a broader warning? Now, there's no question about it. Don, me, I've been bearish inside of the S&P 500 for quite some time now, okay? And I continue to be bearish on the markets. And it's more about risk reward than it is just outright, a lot of times people are like, I'm bearish because I see a certain pattern in here, okay? Why am I bearish? I don't know. Let's open up a 5-year weekly over here. And when you start to open up like a 5-year chart, need I say more? All right. What you have to ask yourself at any given point in time, whether you're an investor, whether you're a trader, in a lot of the positions that you enter, whether they're short duration, again, whether they're long duration, neither here nor there, but in a position like this, if you're just going to be outright long the S&P 500, and you really have to remember that's what most of the public is, just long the markets, right? 401ks, IRAs, just long the market. You literally have to ask that question, what's the upside potential versus the downside risk? And obviously, even if zooming in over here, I mean, whichever zoom angle you want to look at this, right? It's come a long way. And I'm only on a 5-year weekly chart over here. To say it's come a long way is a bit of an understatement. So again, I've been avidly bearish on the S&P 500. Have we been wrong? Sure. Until, of course, we just backed off from 2,400 to 2,342. But let's be incredibly clear about this. The movement that we've made to the downside is absolutely nothing at this point. And when I talk about, bearishness in the marketplace, this is not what I anticipate as being bearish in the marketplace. This is nothing, again, in comparison to the broader spectrum of risk that could be apparent. Now, watching the bonds, again, kind of explode to the upside over here, you have to step back and you better be asking yourself, okay, is this a market that I currently want to be long, seeing that, again, volatility has been on the rise lately. The bonds are displaying risk. Okay, all the stars are kind of aligning for a larger risk event in the marketplace. I mean, what do you need? Do you need some flashing red arrows on the screen before you actually decide to kind of exit stage left if you're still long the marketplace? Now, in addition to it, if you are into earnings announcements, okay, you'll appreciate the fact then Goldman Sachs, by the way, I guess you don't even have to be in earnings announcements to appreciate that Goldman Sachs got hit hard today by a number of almost 5%. This has been interesting, just seeing that it did not pull down the rest of the financials nearly as much as had been anticipated. But at this point, with Goldman Sachs, okay, facing close to what we'll call the 210 mark over here, again, the question is, will it have continuation to the sell side and even eclipse, again, the original election trade when it began? And the election trade, hey, listen, Goldman Sachs was a $180 product at that time. A number of reasons, obviously, from regulation, on up to getting Goldman Sachs from, again, the 180 level to the 255 in a short period of time, obviously giving back on a percentage basis quite considerably here after the earnings announcement. Nevertheless, there's a slew of earnings out over there, but let's not be incredibly myopic in some of the recent trades. Speaking of which, we just had IBM after the bell. You can see IBM down about $6-7 after the bell. Its expected move is right around, okay, the expected move here is right around $6. It's moving just to the outside cusp of what was expected. Again, no real surprises over there. Very likely to even come back right into the expected move. But again, let's not be myopic to any of the individual earnings announcements, because over the course of the next few weeks, yeah, you're going to have the likes of Apple and the Googles, okay, and everybody gets excited. It's Facebook over here. Sure, they're exciting. But there's very likely a much broader move going on. And I think you need to heed the warning of what's going on inside of the bond market. If not the bond market, we pointed out the VVIX, which was all lit up at the 115 level the other day. The short duration volatility indications, they're all there, okay? What is it going to take for people to recognize the degree of risk that exists in the marketplace, and that the risk reward just isn't there, in essence, to be able to hold long positions? Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.